exercise 5-9 has to do with both variable and absorption costing and figuring out the differences and reconciling the differences between those two methods. So we're given here the variable costs for direct material, direct labor, variable manufacturing overhead, and so on and so forth. So it says during the first year of operations, they produced 50,000 units and sold 40,000 units. So we can surmise from there that we've got 10,000 left in our ending inventory. Then it says during its second year, it produced 40,000 and sold 50,000. So produced less. In fact, now it has to go into the ending inventory from the previous year and get those out of the inventory to sell those. So it says the selling price is $60 a month. So the first thing we have to do, okay, so we're going to do the variable costing first. So it says compute the unit product cost for years 1 and years 2. So it wants it by unit, so we're going to look up over here and determine which of these costs we're going to use. So as you all know, I love Excel, so I made a little Excel chart for you here. So you can see that the direct materials are $25, the direct labor is $15, variable manufacturing overhead costs are $15. So we'll go ahead and total that up. And we can see that that's $45. So the variable costs, as we remember from a previous chapter, the variable costs on a per unit basis will not change under the variable costs. In other words, these will always stay the same. I won't move ahead quite yet, but you're going to see that all of these also go on to the absorption costing, but I'll come up with that a little bit later. So now I'm just going to copy this, and you can see I've got $45 per unit for my variable cost. So I'll go ahead and enter that, and you can see that that's the answer that we have right there. So the next thing it wants us to do is calculate an income statement using those variable costing elements that we've calculated earlier. And if we look back up here into the problem, do you remember it said that we sold 50,000, but we've sold 40,000 units? It also gave us our per unit for the revenue. We have our variable expenses here for the product portion. We're going to pick up these variable selling and administrative also as another variable cost and come up with a contribution margin followed by all of our fixed manufacturing, or excuse me, all of our fixed costs, both manufacturing as well as selling and administrative. So if our sales were $60 each, and per unit, that's what we sold them for, and we sold 40,000, then that's pretty easy to calculate. Okay, this is not the hard part. So I'm going to let you do this all by yourself because I'm pretty sure that you can do that. But then, as you can see, we're going to pull that $45 down, and we're going to multiply that $45 times the units that we sold to come up with that. That is our variable product costs. And then we have variable selling and administrative. Now your labels may be slightly different, but I think you get the idea. So the variable selling and administrative are $2. So we all know that if you take $2 and multiply it times how many units were sold, we get this. We'll take up a contribution margin, which will be the difference between the revenue that we made less the variable costs, and here's our contribution margin. And then we'll take our fixed manufacturing overhead and fixed selling and administrative. Okay, so these will be 250 and this will be 80. And there we have our first income statement using variable costing. And for the second year, we'll do the same, only remember the second year we sold 50,000 units. And so we're going to take the same $60, but now we're going to multiply it times the 50,000 that we sold. Same with variable costs. We'll take the 50,000 times that, and then the variable selling and administrative get multiplied by that new unit. I did add in a couple of subtotals because that's what the problem wanted us to do. So I thought to be consistent, I would do that. So then I take my contribution margin and multiply that. Okay, then we got our fixed. Ooh, what's our fixed? Well, I think fixed is fixed. So how about we just take what we did last year and transfer it to this year because it's not going to change. Why is it not going to change? Because it's fixed. Okay, So then our total fixed would be these two. It's a little bit redundant in my opinion, but here we go, minus the total fixed, and there it is. So that's how we do the variable. All right, like I said, that's probably the easy part. Maybe you can skip forward if you don't want to listen to all of that. But then it says, assume the company uses absorption costing. So here we're going to do some thinking. All right, let's go back up to the top. We remember that the absorption costing, the only difference is this fixed manufacturing overhead. So what I mean by it's the same but different is that these same direct materials, direct labor, and variable manufacturing hold true no matter what. So I'm going to go ahead and transfer those over just like that. Now, our fixed manufacturing overhead, as we recall, back up over here is $250,000. How do we figure that out on a per unit basis? Because that's how we're going to allocate it. And what we need to do is remember that the fixed manufacturing overhead, it's always 250. It's fixed, right? But in the first year, we're going to do now is look at how many we produced. So there's the 50,000 we produced the first year. The second year, we produced 40,000. These are numbers and not dollars. I'm going to change those with no decimals. Okay, so I'll even add a little label here so we keep ourselves straight. So here is the number produced and this is the number sold. All right, hopefully that will help you see what we got going here. And then, so if my fixed manufacturing overhead is 250,000, I need to figure out what that is on a per basis. So I'm going to take my 250,000 and divide it by the number of those items produced. So there's my $5. Now the second year, I didn't produce 50,000, did I? I still take my fixed manufacturing overhead, but now I divide it by the 40,000 because that's how many I produced. So hopefully that makes sense. And then we take, well, let's do an add sum here. I got a little easier way to do this. So I'm going to do add sum and we're going to total those together and there's $50 and it's $51.25 for the second year. Okay, so if we sit back and think about this, the reason that they're different is because I produced 50,000 the first year, yet only 40,000 the second year. So I take that fixed manufacturing overhead and I'm always dividing it by the units that were produced. So, all right, so we've got that going for us. And here's our check, $50, $51.25. So we're doing good. The next thing it says is prepare an income statement for years 1 and 2. And we know that under absorption costing, it's actually a little bit different, isn't it? So that was variable costing, so I'm going to hide that. Then we've got absorption costing. Absorption costing. And here we're going to start with the sales. Sales do not change, do they? Sales are sales. Now we're going to come up with cost of goods sold, followed by a gross margin, followed by our selling and administrative, followed by our net income. So to complete my absorption costing income statement, I'm still going to remember how we still sold 40,000. I'm going to multiply it by that same $60 sales price. There's my sales. Then I'm going to take my cost of goods sold, which will be the units that I sold, multiplied times the unit price. And then I'm going to come up with a gross margin, which will be the difference of these two. And then I take my selling and administrative. Up over here, it told me my selling and administrative was 80,000. So I'm going to take 80,000, and I'm also going to add in the variable portion, which was $2 times the 40,000. Where did I get $2? It told me the $2 up here. Where did I get the 40? It said I sold 40 in the first year. There's my formula for 160. My net income is 240. Okay, now I have unhid the variable costing income statement where you can see that the net income under that was 190,000, and you can see that the net income under absorption was 240,000. So now we've got to put on our thinking hats and say, why are those different? I sold the same amount. You can see that sales were $2.4 million under both methods. So it was the way that we costed it. And why are those different? So as you recall, we produced 50,000 the first year and sold 40,000. That leaves us 10,000. I'll write that over here, 10,000 in ending inventory. Now, let's think about what costs were. So under variable costing, you can see that it was $45, but under the absorption costing, it was $50 a month, meaning that there was a difference of $5. Where'd that $5 come from? My variable manufacturing overhead. So if I take the 10,000 units that I have left in my ending inventory and multiply it times the $5 that is an extra cost under the absorption costing, I'll come up with $50,000. So here's one way to look at it. Under the variable costing method, do you see this fixed manufacturing overhead? I completely expensed all 250,000 of that fixed manufacturing overhead the first year. Under the absorption costing, I actually didn't. I only took the amount that I sold, which was the 40,000 times the fixed manufacturing overhead at $5 a month, and expensed that. So said another way, so if you take 50,000 units and you take the total 250,000, that was the variable costing, right? I'll write that over here. I don't know, sometimes I just have to explain this a couple of different ways and sometimes people will get this. So anyway, under the absorption costing, 40,000 of the fixed manufacturing overhead was actually expensed, or 200,000, meaning that 10,000 units that were still in that ending inventory had 50,000 of that. So do you see how this is the absorption costing picture, where and this is dollars, so I'll make that clear, that's dollars, right? That's the fixed manufacturing overhead. It still totals that $250,000. However, under absorption costing, only 200,000 of it was expensed, whereas under variable costing, all 250 of it was expensed. So you can see down here, this cost of goods sold only includes $200,000 of the fixed manufacturing overhead, okay? Whereas under the variable, do you see that? That whole 250 went. All right, so that's why I have this 10,000 units left in my ending inventory, and that is valued at $50,000 extra on top. The variable costing still had a cost attached to those ending units, but when it comes to the absorption costing, it just has a little bit more costs. So that's why you can see the difference between 240 and 190. Now, why is variable costing less? It's less because my expenses were higher. Again, I expensed all 250 of the fixed manufacturing overhead, whereas under the absorption costing, only 200,000 of that was expensed. So lower expenses, higher net income. Now, second year, I'm going to do just the opposite. I'm going to produce 40,000. I'm going to sell 50,000, meaning I'm going to need those 10,000 units from my ending inventory, aren't I? Yes, I am. So this time, because my sales price is 60 and I'm going to sell 50, here's my new net operating income. Now, my cost of goods sold is a little bit tricky. I'm going to put it over here because I'm going to take the 10,000 units that were from last year at $50. Excuse me. I could only type $50. Then I'm going to take the 40,000 that I produced this year and multiply it times my unit cost of $51.25 that I figured for this year. Okay, so if I take that, I just wanted to kind of spell that out to you, right? Because the 10,000 were at $50, right? Remember, under Absorption costing, they were $50. Okay, so I had $50 times the 10,000 left in my ending inventory from last year, and then I produced them this year at 51.25. Okay, so I'm going to take 10,000, multiply that times 50, do order of operation here, I always forget that. Oh gosh, sorry, here we go. And then I'm gonna add that to the $40,000 times the 51.25, and there is my cost of goods sold. So my gross margin will simply be my sales less this. My selling and administrative are going to be slightly different because I had my fixed at $80,000. Plus, I'm going to add that $2 times how many I sold. In this case, this year it's 50,000. And my net income is going to be my gross margin less my selling and administrative. And that is that.